Good afternoon, everybody. I have Goldman Sachs. They reported earnings here a week ago. They started the earnings in the financial sector, and we had a great pop. And we knew that they were ready for this big pop, and it's up real nice. What I am showing here right now is the daily on Goldman Sachs, and you can clearly see that we were leading up to a earnings release with a nice big pop, and we've come all the way back up here to 200. Now it's very bullish, and I'll tell you why. You've got a 2-day buy signal. Now that orange line that you see that is sloping down, that is what we call a 100-day simple moving average, which will be at 206.69. Okay. And the earnings pop, the 3-day follow through, the green line up there at 220, that is a 200-day simple moving average at 221. So basically, we're going to be buying the options again. It's in a very great bull run with the financials leading the way, which Goldman Sachs has not done this for a number of, God, it seems forever. Here it is on a weekly chart. Here it was when we started January that we're in of 19, and we popped straight up now here. Let me show you this thing right here now. So let's get down here and let's get into the nitty gritty. Let's go to our info tool. Now, we can clearly see the 200-week moving average is 207. Now, when we're looking at the other moving average there, which is going to be a significant weekly moving average, is the 20-week right there, and we're hitting resistance. The 10-week simple moving average on Goldman is at 181.19. Now, we make a lot of money making a market in Goldman Sachs. So definitely the breakout, the follow through, the option setup, we're market makers in the options on thousands of stocks. And we definitely like the fact that he's going to be pumping up here to hit these resistance levels. That green line, once again at 207 on Goldman, is the what? Come on. It is the 200-day simple moving average. And then up above here, you got the 50-day in the black. You got the orange color one up there. That's a 100-day simple moving average. The red line is a 20-day simple moving average at 203. So Goldman will continue to bounce. The actual low for 1.6, Goldman was at 172 on the low here. And we have popped up to these highs now, and the high was 203. Okay, so buying the call options at the 170 strike, the 175 call for the monthly options expiration. I'm going to go over that as well and show you what the setup is so that we already make the big move, but there's more room to run, and we're going to show you why right now. Once again, 702-685-0772. Call us today. Get in that free 5-day trial. Watch us live. Treat yourself good. Find out the difference between a market making firm and your retail trading firms. They're night and day. 99% of traders do not even know that call charts or put charts are used. So basically, when these calls were at $1.01, and this is on a daily chart, we ran up here to 724 on the high. That means that this current price level is inflated. So we have to look at the other side of the market. And the other side of that market would be the call option, the 190 put option that is totally deflated down here for $1.40. So trading this as risk management in the option entry is what has to be done. This is deflated, and it is. And I can show you right here, there was 424 traded. The low was $1.42 and the high was 282. Now, let's go to, and remember, this is February 19th. That is February 19th. And that's a 190 put below the market. When we take a look once again, when we take a look at the 205 call, which is going to be up there at resistance, once again, this is the chart. It's inflated, so it can come down real easily. This is what it looks like right here. 406 contracts traded of the $205 February 19th monthly options. They're right here. And they have made their big move. And we were in them and whatnot. But now what we're looking at is not just one side of the trade, but now we have to be concerned and buy the put options. A $200 put option below the market right now, 483 traded. The low was 391, 390 by 420. This is what that $200 put option, February monthly expiration, it's totally deflated, and it is. And this is the side of the trade that is the cheapest side to hedge the risk as a market making firm. FreeOptionTrader.com. Take that free 5-day trial. Once again, you got to get the entries wholesale on both sides of the market. So there is upside based on the daily chart and the weekly chart on Goldman. However, this is the side of the market that we have to buy at the very cheap dollar entry, with the opposite end of the $205 call February. Here's the call chart. Bingo, here it is. Now, let me just caution people. They've made a big move. There is still some room to go up, but it is up here in the inflated area. That's inflated, and the $200 put option is deflated, and we can clearly see that. I can show you the 195 put option. It is deflated down here. It is $2.38. This is the side that has to be bought in case there's a pullback. Then capital is being, protected and whatnot, and get out of the one side if we have to, and we'll let it run. Just know one thing. We're here for you. That's the 205 call that I showed you up and out of the money. Here is the 195 put right here. Yeah, 525 was the volume. Last trading day, 445, 238 on the low, and that's the 195 put. Learn how to be a market maker. Call us today. Let's get started. Join the free 5-day trial. Watch us give out the entries and the exits. And who are we giving them out to? You.